Welcome to Big Business This Week. I'm JD Durkin here on the trading floor of the New York Stock Exchange as recession fears continue for some on Wall Street and tariff news certainly not slowing down anytime soon. There is no shortage of things to unpack this week in the world of business news. Plus, we'll be breaking down how one AI company wants to start its own social media platform, and are the constant rule updates at Starbucks actually helping the company's business. Joining me this week to break it all down is Sarah Foster, economic analyst at Bankrate. Sarah, good morning. I appreciate you being here. Of course, let's start with the overall markets. As you and I are taping this, we're down fractionally. It does seem as if we've somewhat normalized given all the chaos and uncertainty of the last few weeks. I'd like to start with the comments from Jerome Powell yesterday. What stood out to you when we listened to the chairman of the Fed speak, and why do you think markets continued their sell-off into the close as a result?
Yeah, it's great to be here. Thanks for having me. I think something that, a lot of the attention has been focused on how Fed Chair Jerome Powell mentions that tariffs are higher than they expected, meaning the impact to inflation and the impact to economic growth is certainly going to be sharper than expected. But I think, that's something continued comments from what we had seen in the previous few weeks. I think, especially to me, what stood out is kind of Powell mentioning here that the Fed's dual mandate is expected to be in tension with each other. And in fact, he further clarified here that he sees that both its inflation goals and its labor market goals moving away from their target. So, you'll never really hear Fed Chair Jerome Powell say the word stagflation, but of course, that's really kind of the buzz on the street, and at least according also with economists. There's lots of specific qualifications that would need to be fulfilled in order for us to say that our economic environment is stagflationary. But I think the message for everyday people is that they might already feel like they're in this stagflationary environment, especially as we are expecting inflation to increase. And as we see surveys suggest that many workers aren't feeling confident about their job stability and the future direction of the labor market.
Sarah, so given where we are right now, what would be a few of those potential pieces of data you would look for that might reinforce the so-called stagflationary argument? Is it simply looking at unemployment go a bit higher? Is it simply seeing some of the economic growth projections start to kind of stall out? Is it a combination of lots of things?
Yeah, there's really three main ingredients that I'd be looking for to qualify for stagflation. Number one, you would need to see this persistent increase in inflation. What we also saw number two during the 70s and 80s, which was the most disastrous bout of stagflation that we ever experienced, was there were a lot of policy missteps, meaning the central bank kept interest rates too low, further fueled that inflation. That second qualification, we're not really expecting that. We really hear from Fed Chair Powell and company here that they're scarred from that experience and even burned from post-pandemic inflation. That's why you probably haven't really heard Powell mention the word here about transitory when it comes to tariffs, the way that he probably kind of skirted around during the March press conference. That third requirement here, though, is really that increase in unemployment. And I think what I often like to look at is the misery index. That's when you get the sum of both the inflation rate and the unemployment rate. Of course, you'd want to see a lot of that coming from inflation in order to constitute as stagflation. But a lot of economists that we talk to, and even in our quarterly forecast surveys, they mentioned that in order to constitute a stagflation, you'd probably need to see inflation be about a percentage point above the Fed's target and the unemployment rate about a percentage point above its current estimates of maximum employment, which continue to be in about the 4% range.
Sure. To clarify, is there one particular piece of inflation? Is it PCE? Is it core PCE? Is that the one that reigns above, or sort of aggregate of the three big ones we get between labor and commerce every month?
You do tend to see all of them move in the same trends, but as we
Yeah.
often hear from Powell and Co. here, that PCE is really that benchmark that they're looking for because it adjusts for some of the substitutions that consumers make. And of course, core PCE is kind of that underlying measure of inflation when you exclude those volatile categories. So really, we're thinking about a percentage point above the Fed's target for the PCE deflator.
I want to get your reaction to something you may have seen the president put out on social media today. He says that the termination of Jerome Powell, quote, cannot come soon enough. We're kind of wrestling with this question of Fed independence. I know the chair of the ECB was asked about it early this morning. during her press conference. Is that something you expect to be front and center, and any type of either projection or sense on how that plays out? Because whether or not he's supposed to, we do have the president now once again kind of putting more of that public posture pressure on Jerome Powell.
Well, something that is happening at the Supreme Court is really they're expected to decide a court ruling that might grant, something is expected to, kind of give further clarity on what powers the chief executive has as far as, an ability to remove someone who's technically a regulator, more so like an at-will employee, the way you think about a Treasury secretary. You even saw Fed Chair Jerome Powell answer questions about that yesterday in his public remarks. The way he's been describing it is something that they're watching very closely. They're not expecting that it could impact the Fed chair's position. But, it is something that I think is top of mind for many investors, especially as you think about kind of the reasoning behind Fed independence and why Congress has really stood behind Fed chairs is an independent central bank has really seemed to be kind of the foundation for lower levels and more stable levels of inflation. And of course, as stagflation really becomes that big topic of discussion, it's, something that really happened during the 70s and 80s to make the economy, feel that way was because of Arthur Burns and some of the job owning that President Richard Nixon was able to succeed at. So I think it's really top of mind here. But of course, you will always hear from Fed officials publicly and even in comments that they have with us in the media. They always are trying to put the economy first. Never do conversations about politics get in the way. So I think they're just going to try to keep doing business as usual and keep looking at their dual mandate.
Meanwhile, the reality is, and I would argue, someone like Jamie Dimon from J.P. Morgan Chase historically has a bit more of a skeptical or a slight more bearish posture. I think in general, CEOs tend to be a bit defensive, but obviously, as you know, Sarah, his comments recently basically saying, hey, we've got a coin flip right now, 50-50 odds of a recession. I know Bankrate has a really cool economist survey about overall recession odds as well as how business leaders are feeling. Walk me through some of that data, and are you surprised to now hear so many influential voices in publicly traded companies and around Wall Street now raising at least the potential for a recession, given all of the uncertainty and how the financial markets, stocks, bonds, and others have responded the last couple of weeks?
Yeah, well, it certainly comes at a pretty heartbreaking time, I would say, for the economy, considering that it looked just a few months ago that Fed Chair Jerome Powell and the rest of the central bank was able to kind of engineer that soft landing. You hear the Fed say that the economy is still in solid shape, at least when you look at the hard data. But it is really this soft data where you're starting to see concerns about a recession pop up. And, to answer your question, am I surprised? I think we hear time and time again from consumers and from businesses, they're the engines of economic growth. And if you're uncertain about the direction of the economy, these volatile stop and go trade announcements, you probably don't feel very confident in your decision making ability to maybe know if it's time to invest in expanding, know whether it's time to hire more workers, or even as a consumer, maybe know whether it's time to make that big ticket purchase. So uncertainty really is not pro growth. And I think that's why you're seeing even in our economist survey, those recession odds have come up. Of course, not as much as maybe other, big players on Wall Street. We even saw Morgan Stanley here mention that, 60% odds of a recession. Currently, our survey is showing about 36%, which was up from 26% last quarter. Still relatively low. It's been as high as about a 2 in 3 chance, to put it in perspective. But I think it's the pace of the increase that we really saw here. The biggest jump since the third quarter of 2022, and that's really what's catching our eye.
Sarah, could there be any of this where we kind of have a slow growth environment because it becomes a self-fulfilling prophecy where Americans become increasingly concerned about the cost either of doing business or what they're spending money on? And so out of those potential fears, they start to pull back themselves, given we're an economy that's 70% exposed to consumer spend in terms of our overall GDP. And then at what point do we kind of have the psychological impact where we might kind of accidentally stumble into a recessionary light environment because people are worried about a recession, so they start acting as if we are heading for a recession, which ultimately may kind of lead us there?
Yeah, yeah, and I feel like all both of us here probably have some deja vu from what we were talking about just 3 years ago with, the so-called vibe session, and how if you feel bad about the economy, the fear is that it might cause you to pull back on those purchases, and then your negative sentiment about the overall financial system often becomes that self-fulfilling prophecy. I think what we're about to see here is that back then, the vibe session really did not translate to slower economic growth. And we saw that even though Americans had souring sentiment, they still continued to, show up at restaurants, spend big on experiences, vacations. But I think, the difference here too is that today we're in a much different state than we were back in 2022, particularly with the labor market. I mean, one of my favorite trackers is looking at the Atlanta Fed's wage growth measure, which is kind of also showing the difference between someone who job hops and then someone who stays at their position. That wage premium that you often get when you job hop. And today it's much more similar. That premium doesn't exist the way that it did 3 years ago when we were in the middle of a great resignation. And so I think, one thing that we might see here is that the vibe session really requires that, the labor market runs hot. If we did see that Americans were continuing to spend, probably because they still had paychecks to rely on and were a little less worried about their job stability. So now, if you get both inflation and an increase in unemployment, or even if it's just a tougher time to find a new position in general, that's when I think you might start to see that self-fulfilling prophecy really take hold.
Great resignation and vibe session, two phrases I haven't heard of in a while. So, yeah, a bit of deja vu there, but I appreciate the context because I think that is important context. Are there any surprises to you in the Economist survey? Anything that stood out that maybe you weren't expecting?
Yeah, well, I think something that I had been keeping my eye on is how economists were looking at their inflation measures versus how the Fed was looking at their inflation projections. And we really saw that the Fed, in the past three projections that they've released on a quarterly basis, that they've continued to expect that inflation would remain higher than their 2% target through at least 2027. Economists were much more hopeful. The past several quarters, they have started to upgrade those estimates as it did look like inflation was kind of slowing its progress back to 2%. But now, in this latest survey, we're really seeing here that economists are upgrading their inflation forecasts even more, and they're not as optimistic as the Fed, or they're less optimistic than the Fed here. 55% of economists now expect that inflation will remain higher than 2% through at least 2027, which is now matching the Fed's projections. And just to give you a perspective of how big of an increase that was, 55% this quarter, just 15% of economists last quarter mentioned that they thought inflation would stay that hot. And of course, the reason why they're expecting that higher for longer inflation is all because of tariffs.
I'd love to ask you. I got a lot of things I want to ask you about, but I know we're short on. We're somewhat limited on time. I do want to ask you about the overall Nvidia storyline. Obviously, a big running narrative right now is the rotation out of the big technology and the cyclical names that have been responsible for the bull market the last few years. But in a real front and center way with all the tariff uncertainty. I mean, what just an incredible couple of weeks. Unfortunately, so if you are an Nvidia investor, for the company that has been the AI darling, the stock is currently trading down 20% underneath its 200-day moving average. So volatility has always been the story there, but especially now. I wonder what you made of the weekend's news, if you caught it, where it seemed as if we had these exemptions that would benefit the Apples and Nvidias of the world, only to somewhat be undercut by comments made Sunday by Secretary Howard Lutnick, who said, well, just wait a little bit because we haven't even rolled out the semiconductor tariffs yet. And everyone's like, what semiconductor tariffs? And so that just kind of speaks to the uncertain messaging. What do you make of how that disparate messaging is impacting some of the mega caps that have been really responsible for a lot of our gains for a long time?
Yeah, well, something that I, as an economy analyst, have really been looking for is this question of will President Trump's, purpose for tariffs, which seems to, we kind of get back and forth here on whether it's just a negotiation tactic or something more permanent to at least bring manufacturing jobs back to the U.S. I'm really focused on that latter part. What will it take for President Trump's tariffs to really be successful in bringing back those positions? And I think the uncertainty really makes that difficult for a lot of companies who are trying to plan. They don't really know what tariffs are going to look like from a given week, which means it's harder to know whether to justify the expense of bringing back your activity and reshoring. I think, this is one of those examples here where you really don't know, businesses really don't know what to expect next.
There's a big debate about whether or not tariff price increases will be a one-time price increase or whether they will be more steady. And these will be pressure, spending, pain points consumers will feel in increments over a long time. Is there any data that leads you to one conclusion over another right now, Sarah?
Yeah, I think we're all really closely watching the consumer price index to really see how quickly those higher prices filter through to the broader economy. But
Mhm.
of course, I think that the pandemic is really this best, master class example of how these one-time supply shocks can often feed through into broader inflation. I think the best example here is, think about gym memberships. If a gym is suddenly paying more on, if it costs more to purchase weights, if it costs more to buy treadmills, something that is just a service, those services aren't really hit with tariffs, but because those higher costs are kind of impacting their business, that might then translate into the costs that you pay for your monthly gym membership. This is just one very specific example, but I think it is something to really show here. The longer this uncertainty goes on, the less, ability companies have to really judge how much they should hike prices in the face of tariffs. That really is something that I think could make it difficult for Fed Chair Jerome Powell to really discern whether this is that one-time price shock versus something that could be more longer lasting.
This is why I've said we know the presidency is an incredibly important job, but I don't know if anyone's had a harder job these last 4 to 5 years than the chairman of the central bank. And it doesn't seem as if those challenges are going away anytime soon. Sarah, while we have you, we have time for a few more topics. Let's talk about OpenAI in the world of tech. The company is now teasing its own social media platform, and I wonder your kind of takeaway as you look at the work of Sam Altman from a big picture view on what that might look like, and do you think there's an appetite for consumers who want a sort of AI fueled social media channel? God, there's so many social media channels out there.
Yeah, it'll certainly be interesting. I think you can certainly see kind of the fads here of come and go social media sites that we really saw back during the pandemic. It's really hard to see, which ones stay for longer and become the next TikTok versus those that just are kind of one and done after a while. Of course, me from my personal finance perspective, I really look at these social sites and I wonder, is this just a new way for Americans to kind of come across this, not very vetted, poor financial advice. I think that's something that I always kind of keep my eye on. But of course, it's hard to predict the future. I think if we could predict the next big social media site, we would definitely be in a different industry here, I think.
Then I assume we could also predict what happens with the markets, and we certainly can't do that. I am curious, a bit of a personal question. Do you find yourself using a lot of these platforms? Are you experimenting with ChatGPT and the perplexities and the notebook LMs of the world at all in your work?
Yeah, sometimes I think something that you often hear from a lot of economists as it relates to these AI platforms is that it really bolsters someone's productivity. I think in my own life, I use this a lot for my Excel spreadsheets, my Google Sheet analysis. I think it really speeds that up and helps teach you, how to analyze large data sets quicker, which someone who didn't really come from this world. I think that really is just one example of how AI can really be used to kind of boost that productivity. And of course, from the economic standpoint, more efficient workers, that's good for overall economic growth and actually deflationary. But of course, we got to let some of this other dust settle before we can predict those longer run trends.
And there's no shortage of dust to be settled. Finally, Starbucks enforcing few new company rules here, and it's a bit of a social story, but also a business one as well. You may have noticed the new CEO enforcing a lot of old, yet also what's old again is new again type rules, trying to get business back on track. They're going to write people's names on the customers' cups. I think that one's kind of fun. They do want to remove unpopular menu items, now getting a little bit stricter about the employee dress code. What stands out to you about this old but kind of new look strategy for a company like Starbucks? It's obviously coffee's a competitive space.
Yeah. I think, we do kind of see those trends a lot. I think especially as you relate to the productivity booms that a lot of us are even talking about. I think it relates back to we kind of were wondering whether, I mean, at least before all of the trade policy uncertainties, we were kind of wondering of whether we were going back to an economy in the 1990s. So I think it's a little on the nose here for Starbucks to kind of bring back that on what's old is new again kind of philosophy. But I think that competitive is right, and especially as you do start to see the economy, as we're looking for that soft data to kind of reflect what's, as we look for what's happening in the soft data to reflect what's happening in the hard data. I think companies like Starbucks and these little, low expense, discretionary purchases, they really know that sometimes those are the first to get cut in an uncertain economy. So you could probably start to see here that maybe Starbucks is attempting at least to get ahead of that in the way that they think they can.